stop scrolling, stop whatever you're doing right now. What I'm about to show you is the most explosive financial document to leak from Wall Street in the last decade. This isn't theory. This isn't speculation. This isn't some analyst making predictions for views. On January 8th, 2026, at exactly 3:47 p.m. Eastern Standard Time, an internal Goldman Sachs memo marked Confidential Executive Committee only was leaked to commodities traders. I have this document, 10 pages, and buried on page 7 are 7 words that confirm everything we've been saying for 15 years, 7 words that prove the manipulation is over, 7 words that change the entire game. Those 7 words: silver short position no longer defensible, initiate covering, Goldman Sachs, the vampire squid, the institution that's been fined over $4 billion for precious metals manipulation and kept doing it anyway, the bank that laughed about smashing the gold bugs on recorded phone calls. The final boss of silver suppression has just admitted in writing that they cannot hold their position. They're trapped, they're covering, and their own internal models calculate the price target when covering is complete, $412 per ounce. Let me be crystal clear about what this means. This is not a research report for clients. This is not marketing material. This is Goldman's chief risk officer telling their own executives what is mathematically guaranteed to happen when they're forced to buy back 7 billion ounces of silver they sold naked over the past decade. Goldman Sachs has run the numbers, built the models, and calculated the outcome. Their conclusion: 412 of silver, and the covering starts today. Right now, this moment. Goldman has 45 days to reduce their short position by 60%, or the CFTC liquidates them. That's 116 million ounces they must buy every single day. The normal daily volume in silver? 8 million ounces. Goldman has to buy 14 times normal volume every day for 6 weeks straight. This is the death certificate of silver price suppression. The war is over. We won. And I'm going to show you exactly what's in this memo, why Goldman has 0 escape routes, and what you need to do right now before this explodes. The smoking gun inside the memo. The document is titled Silver Position Risk Assessment and Mandatory Covering Protocol. Prepared January 7th, 2026. Distributed to 12 Goldman Sachs Executive Committee members the next morning. And Section 1 opens with a position summary that should make every single person watching this video stop and pay attention. Goldman Sachs is short 8.73 billion ounces of silver. Let that number sink in for a second. Global silver production from every mine on planet Earth? 800 million ounces per year according to the Silver Institute. Goldman is short 8.73 billion. That's 10.9 years of total worldwide production. If every silver mine on Earth stopped selling to industry, stopped selling to solar companies, stopped selling to electronics manufacturers, stopped selling to everyone, and dedicated 100% of output exclusively to Goldman Sachs, it would take almost 11 years to cover their position. This isn't a short position, this is financial suicide, and Goldman just realized they're holding the gun. The memo states this position was built between 2016 and 2025 at an average price of $41 per ounce. Current price on January 6th when they wrote this? $82. Every single ounce has doubled against them. The current unrealized loss? $357 billion. $357 billion. That's more than Goldman's entire market cap. That's more than the GDP of most countries. And it gets worse every single day because every $1 that silver rises costs Goldman another $8.7 billion in losses. When silver hits $90, their losses expand by $69.6 billion. When it hits $100, they're down $513 billion. The position has gone from manageable risk to existential threat, and the memo admits it in plain English. The short position is no longer manageable through traditional price suppression techniques. Physical market conditions have deteriorated to a point where paper market control is no longer effective. Covering must commence immediately. Goldman Sachs just admitted the manipulation is over. They can't suppress the price anymore. They've lost control. Game over. The regulatory hammer, CFTC forces Goldman's hand. But here's where it gets absolutely insane. Goldman isn't just covering because they want to. They're covering because they've been ordered to by federal regulators. Section 2 of the memo drops the bomb. On January 6, 2026, Goldman Sachs received formal notice from the Commodity Futures Trading Commission Division of Enforcement requiring the firm to reduce its net short silver position by a minimum of 60% within 45 calendar days. The CFTC just gave Goldman a mathematical impossibility disguised as a deadline. To hit 60% reduction, Goldman must purchase 24 billion ounces before February 20th, 2026. That's 116 million ounces per day, every day, for 45 days straight. The global silver market trades 8 million ounces daily. Goldman has to buy 14 times normal volume every single day for 6 weeks. There aren't enough sellers. There isn't enough liquidity. The only way this happens is if the price goes absolutely vertical to bring sellers to market. And Goldman's models calculated exactly how high the price must go to generate enough supply, $412 per ounce. At 412, Goldman projects that 8 billion ounces come to market from weak hands taking profits, from industrial users liquidating excess inventory, from ETF redemptions, from sovereign sales. At $412, they can cover approximately half their position. The rest gets covered through forward contracts with miners at locked-in prices, but to get to $412, they have to start buying now, today. And that buying pressure is going to drive the price from $80 to $412 in a matter of weeks. This isn't speculation. This is Goldman's own risk management team calculating the inevitable outcome of forced buying. The physical delivery crisis, Goldman's nightmare. Now here's the third crisis that makes Goldman's situation absolutely desperate. They can't just roll their positions forward like they've done for years. They're facing a physical delivery crisis that's about to detonate. Physical delivery crisis. February 2026. COMEX silver contracts, 58 date, 900 contracts standing for delivery. That's 294. 5 million ounces of physical silver being demanded. Goldman is obligated to deliver against 14,200 contracts. That's 71 million ounces of actual metal they promised to deliver. Goldman's allocated silver inventory as of January 6th, 1 million ounces. They can satisfy 31% of their delivery obligations. They're short 48. 9 million ounces that they promised to deliver in 4 weeks and do not possess. Failure to deliver triggers catastrophic legal consequences. The memo references the 2022 London Metal Exchange nickel default, where failure to deliver resulted in class action lawsuits seeking $400 billion in damages. Goldman faces 2 choices: buy 48, 9 million ounces in the spot market immediately at $82 per ounce, costing $4 billion, or negotiate cash settlements at a premium of $88 per ounce, costing $3 billion. But this isn't just February. March contracts are showing 67,000 contracts standing for delivery. That's 335 million ounces. April is even worse. Goldman faces an escalating delivery crisis that compounds every month. The only solution is to cover the entire short position and eliminate their delivery obligations permanently. The memo's recommendation is crystal clear. Initiate immediate physical purchases to satisfy February deliveries and simultaneously begin covering remaining short position to avoid March crisis, which projects to be significantly larger. Goldman must buy today, buy in size, buy at any price, because the alternative is default. And if Goldman defaults on a commodity contract, the contagion spreads through the entire financial system. Saudi Arabia enters the arena, the game changer. Now we get to the factor that transforms Goldman's difficult situation into an absolute bloodbath. Section 4 analyzes Saudi Arabia's newly announced strategic silver acquisition program, and this is where Goldman realizes they're not just fighting market forces, they're fighting sovereign wealth. On January 7, 2026, the Kingdom of Saudi Arabia announced through official state media that they will allocate 15% of annual oil export revenues to silver purchases as part of strategic resource diversification. Saudi oil revenues, $180 billion annually. 15% equals $27 billion directed to silver purchases. At current prices of $82 per ounce, that's 329 million ounces of annual demand from a single buyer. That's 41% of total global mine production. Saudi Arabia just became the largest silver buyer in world history overnight. Goldman's memo states Saudi purchasing commences in February 2026 with initial targets of 50 million ounces per month. But here's the sentence that should terrify every short seller. The Saudi program is non-price sensitive. The kingdom views silver as a strategic reserve asset and will purchase at prevailing market prices regardless of level. Saudi Arabia isn't trading for profit. They're not trying to time entries or buy dips. They're converting dollar-denominated oil revenues into hard assets as fast as possible because they know what's coming to the global monetary system. They'll pay $82, they'll pay $100, they'll pay $150, they'll pay whatever it takes because their objective is strategic accumulation before the dollar system transforms. The memo states, this creates a permanent bid in the market that eliminates downside price risk. Goldman's models indicate that Saudi demand alone is sufficient to support a silver price floor of $95. Combined with Chinese demand and Goldman's forced covering, the confluence of buying pressure makes price suppression mathematically impossible. Saudi Arabia alone creates a $95 floor. Add China. Add Goldman's mandatory 24 billion ounce covering. Add the other shorts who will panic once they see Goldman buying. The buying pressure becomes overwhelming with zero comparable selling to offset it. This is the perfect storm, and Goldman is trapped in the center. China's silver accumulation. The silent tsunami Section 5 breaks down Chinese demand, and the numbers confirm what many suspected but couldn't prove. The People's Bank of China has expanded M2 money supply to $51 trillion as of December 2025. That's an increase of $48 trillion since January 2020. For context, the entire United States M2 money supply is $21 trillion. China has created more than twice the total U.S. money supply in 5 years. And Goldman's intelligence indicates China is directing massive portions of this liquidity towards strategic commodity accumulation, including silver. Estimated Chinese silver purchases in 2025, 430 million ounces. That's 54% of annual global mine production, consumed by one country. But here's what makes Chinese buying particularly devastating for shorts. Demand accelerates when prices rise. Goldman's China desk reports that Chinese buying actually increases at higher prices, which is completely contrary to normal market behavior. When oil prices rise, people drive less. When food prices rise, people buy less. But China isn't responding to price signals because they're not market participants. They're strategic accumulators preparing for a post-dollar world. The Memo projects Chinese demand in 2026 will hit 580 million ounces, consuming 73% of total global production. Think about this. Chinese demand takes 73% of all mined silver. Saudi Arabia's program takes another 41%. That's 114% of global production claimed by just 2 buyers before industry, electronics, solar, jewelry, retail investors, or anyone else gets a single ounce. The market is in massive structural deficit before Goldman even begins covering, and Goldman needs to buy 24 billion ounces. Where does that silver come from when annual production is 800 million and China plus Saudi Arabia are claiming all of it plus more? The only source is existing above-ground stockpiles, and holders of physical silver aren't selling at $82. They're not selling at $100. Goldman's models show they start selling in meaningful volume at $412. The paper-VES physical divergence. The system-breaking Section 6 addresses the divergence between paper and physical markets, and this is Goldman's existential nightmare. Right now, COMEX futures show silver at $82, but try to actually buy physical silver at that price. You can't. Physical silver eagles from the U.S. Mint, trading at $110 on secondary markets according to live data from APMEX and JM Bullion as of January 8th. Physical 100-ounce bars, $105. Even large 1,000-ounce commercial bars delivered to COMEX warehouses carry an $18 premium over spot. The physical market is already pricing in the shortage. Physical buyers don't trust paper pricing and are paying $25 to $30 premiums per ounce for guaranteed delivery of actual metal. Goldman's analysis warns, if premiums exceed $35, the COMEX loses credibility as price discovery mechanism. If credibility is lost, physical market decouples permanently from paper market. This would result in 2 distinct silver markets: paper market trading at suppressed prices with cash settlement, and physical market trading at true clearing prices potentially 200 to 300% higher. This is the nightmare. If paper and physical markets completely separate, paper contracts become worthless. Everyone demands physical delivery, and Goldman, holding 73 billion ounces of paper shorts, gets annihilated when forced to deliver physical metal that doesn't exist. Their only option: cover paper positions immediately, reduce selling pressure, and allow paper prices to rise toward physical reality before the entire COMEX structure collapses. The Memo's recommendation? Begin covering paper shorts to reduce selling pressure and allow paper prices to rise toward physical reality. Goldman must close their positions before the paper market dies, and they must do it now. The supply cliff. Why Goldman can't wait. Section 7 explains why even if Goldman wanted to cover slowly over years to minimize price impact, the physical metal simply doesn't exist. Global silver mine production in 2025, 783 million ounces. Projected 2026 production, 786 million ounces. That's growth of only 1%. Production has flatlined despite silver doubling from $20 in 2020 to $82 today. Why? Grade degradation. Average silver ore grade in 2005, 15 ounces per ton. Average ore grade in 2025, 4 ounces per ton. That's a 73% reduction in ore quality over 20 years. To produce the same amount of silver, mining companies must now process nearly 4 times as much rock, consuming 4 times the energy and generating 4 times the waste. This makes silver production extremely sensitive to energy costs. At current energy prices, many primary silver mines operate at or below break-even at $80 silver. If energy costs rise or silver prices fall, these marginal mines shut down, reducing supply further. Goldman's analysis concludes that to incentivize new mine development, silver must reach at least $150 per ounce. But new mines require 8 to 12 years from discovery to production. For the next decade minimum, silver supply is fixed at approximately 800 million ounces annually. There's no ability to rapidly increase production regardless of price. Goldman needs 600 million ounces per year for 18 months. Mining produces 800 million, but 700 million is consumed by industrial applications that can't be interrupted. That leaves only 100 million potentially available from new production. Goldman needs 600 million. The remaining 500 million must come from existing stockpiles, which means physical holders must be convinced to sell, and the price that brings them to market, 412. The timeline. When this explodes. Goldman has prepared a detailed covering schedule in the memo, and the timeline is absolutely insane. February 2026. Purchase 120 million ounces, 23% of required 60% reduction, complete March 2026. Purchase 140 million ounces, 50% complete April 2026. Purchase 160 million ounces, 78% complete. May 2026. Purchase 100 million ounces, 97% complete. June-July 2026. Fine-tuned to hit exactly 60% reduction. The schedule front-loads buying into February, March, and April. Why? Because Goldman wants to complete the CFTC mandate ahead of deadline with margin for error, but also because they're trying to cover before other major shorts recognize what's happening and begin panic covering. Goldman is attempting to buy quietly through multiple brokers, breaking orders into small pieces to avoid algorithmic detection. But 140 million ounces per month isn't small. That's 17% of annual global production purchased in 30 days. The market will notice. Prices will move violently. And when prices move, other shorts holding a combined 5 billion ounces, according to the memo's estimate, will recognize the danger and attempt to cover. That's when the cascade begins. That's when 412 becomes conservative. That's when Goldman's worst-case scenario potentially unfolds, $627 per ounce. The risk scenarios. Best case to nightmare. The memo includes detailed risk modeling with 3 scenarios. Best case. Everything proceeds smoothly. Goldman sources silver without major disruptions, $374 per ounce. Median case, normal execution challenges, standard market response, $412 per ounce. Worst case, delivery demands accelerate, Saudi buying exceeds projections, other shorts cover simultaneously, $627 per ounce. $627 isn't wild speculation. That's Goldman's internal risk team modeling the high-end outcome if multiple negative factors align. And given that Saudi Arabia already announced their program, China shows no signs of slowing, and the CFTC mandated covering with a hard deadline, the worst case is absolutely possible. The memo states, estimated total short interest across all market participants, 13. 2 billion ounces. Goldman's position represents 66% of total short interest. When Goldman begins covering, other shorts will be forced to cover simultaneously to avoid being last. This creates a cascade covering event that models predict will drive prices above median scenarios. Highest probability outcome, $450 to $550 per ounce. This is a short squeeze on a scale never seen in commodity markets. If all shorts try to cover simultaneously, there isn't enough silver on Earth. The price goes vertical, and Goldman knows it. That's why they're covering first, trying to get out ahead of the panic. The geopolitical bombshell, wealth transfer to the East section. 9 analyzes geopolitical implications, and here Goldman acknowledges they're financing a massive wealth transfer to nations competing with Western interests. China holds an estimated 1 billion ounces of silver in strategic reserves. Russia holds 340 million ounces. India holds 270 million ounces. Combined BRICS nations control 2 billion ounces. At current prices of $82, BRICS silver reserves are valued at $262 billion. At Goldman's target of $412, those reserves are worth $1, $32 trillion. The appreciation represents a wealth transfer of $1. $6 trillion from Western financial institutions to Eastern resource holders. Goldman is effectively financing the appreciation of adversary nations' strategic reserves. They understand the implications. They recognize they're strengthening competitors, but the memo states they have no alternative. Failure to cover results in Goldman's insolvency, which poses systemic risk to U.S. financial markets. Recommendation: cover, despite geopolitical wealth transfer implications. Systemic risk mitigation takes priority. Goldman is attempting to buy quietly through multiple brokers, breaking orders into small pieces to avoid algorithmic detection. But 140 million ounces per month isn't small. That's 17% of annual global production purchased in 30 days. The market will notice. Prices will move violently. And when prices move, other shorts holding a combined 5 billion ounces according to the memo's estimate will recognize the danger and attempt to cover. That's when the cascade begins. That's when $412 becomes conservative. That's when Goldman's worst-case scenario potentially unfolds, $627 per ounce. If Goldman fails on a commodity position, contagion spreads through the financial system, so they cover, they pay, they transfer the wealth, because the alternative is total collapse. The final calculation, $218 billion loss. The executive summary crystallizes everything into brutal clarity. Goldman Sachs' proprietary silver short position is indefensible and must be covered immediately. Regulatory deadline, 45 days. Physical delivery crisis, imminent. Market dynamics, deteriorating daily. Projected silver price upon completion, $412 per ounce. Projected losses on covering operation, $218 billion. Projected losses if covering not completed. And CFTC force liquidates, $634 billion. Recommendation: covering is the least bad option. Begin immediately. Goldman is going to lose $218 billion covering this position. That's the cost of 20 years of manipulation. That's the price for thinking they could control markets indefinitely through unlimited paper creation. That's what happens when you short 10. 9 years of global production, and they're paying it because the alternative, $634 billion in losses from forced liquidation, is catastrophically worse. What this means for you: the do not sell message. Now listen very carefully, because this is the most important part. Goldman is going to try to shake you out. They need your silver. They're short 7 billion ounces. You're holding some of those ounces, and they want to buy them from you as cheaply as possible. Do not sell. When silver hits $100, do not sell. When it hits $150, do not sell. When it hits $200, do not sell. Goldman's own memo says the target is $412. Why would you sell at $100 when Goldman is modeling $412? Why would you hand them your silver cheap when their own risk models say it's going to $412 minimum, potentially $627 in the worst case? You are holding the winning hand. Goldman needs your metal to survive. Do not give it to them cheap. Let them pay $412. Let them pay $600 if it goes to the nightmare scenario. Every ounce you hold is leverage against them. They are trapped. You are not. They must buy. You do not have to sell. And the longer you hold, the higher the price goes. This isn't a trade. This is a siege. You're on the winning side. Goldman admitted defeat in writing. They calculated their own destruction at $412. Don't rescue them at $100. The volatility warning: prepare for chaos. Section 8 warns to expect unprecedented volatility during the covering operation. Goldman projects daily price movements of 5% to 15%, circuit breakers, triggering regularly as exchange limits are hit, price gaps where no trading occurs because bids exceed all offers, days where silver opens at $120 and closes at $145, days where it gaps from $180 to $210 with zero trades between. This won't be smooth. This will be violent, chaotic, with algorithms breaking down, shorts panicking, FOMO buying accelerating, physical shortages intensifying. There will be days you see your position up 20%, days you see it down 12%, days where you can't even get a quote because there are no sellers at any price. Hold through the chaos. Goldman's own models say the endpoint is $412. The volatility is just the journey there. The paper market death. COMEX losing credibility. Physical premiums are already screaming the truth. Silver eagles at $110 when paper shows $82. Bars at $105. Commercial bars at $100. The physical market is $25 to $30 ahead of paper pricing. The memo warns if premiums hit $35, the COMEX loses credibility as price discovery mechanism. We're already at $28 to $30. We're on the edge of complete decoupling. When that happens, paper contracts become worthless. Everyone demands physical. Goldman holding 7 billion paper shorts gets destroyed. That's why they're covering now. Before the system breaks, before paper and physical split completely, before their positions become literally unwindable. The enemy has surrendered. This is victory. Goldman Sachs, the vampire squid. The institution that wrapped itself around precious metals markets and sucked value out through manipulation for 2 decades. The bank fined $920 million in 2020 for spoofing and manipulation, fined another $2 billion in 2023. The bank with recorded phone calls of traders laughing about smashing the gold bugs. They have surrendered. Total capitulation. White flag. Game over. The memo is their confession. The $400 target is their death sentence. The 45-day timeline is their execution date. We won. The war is over, and now we watch them pay $218 billion for the privilege of covering their positions. The final alert, 412 silver locked in. This is not speculation. This is not some YouTuber making predictions for views. This is Goldman Sachs' own chief risk officer calculating the mathematical outcome of covering the largest commodity short position in human history. They've run the models. They've done the math. They've analyzed every scenario. Their conclusion, $412 silver when covering is complete. The memo is real. The 7 billion ounce short is real. The $412 target is real, and the covering starts today. Goldman has 45 days to buy 24 billion ounces. That's 116 million ounces per day in a market that trades 8 million, 14 times normal volume. Every day, for 6 weeks, impossible math, vertical price action, 412 minimum, potentially 627 if other shorts panic. This is the endgame. Goldman Sachs has flipped. The final boss has fallen. The manipulation is over. The price suppression is finished. Hold your silver. Watch Goldman buy at any price. And when the price hits $412, decide if you want to sell or hold for $600. The death certificate of silver manipulation has been signed. Goldman Sachs wrote their own obituary, and we're holding the asset they need to survive. The alert is red. The target is locked. $412 silver is coming, and it starts today. This is not a drill. This is the moment we've been waiting for. Goldman has surrendered. The war is over. We won.